Now we are going to have a discussion on base metals and the outlook for the base metals market. And I'm delighted to welcome to the stage, do we have John Mayer, who's partner and mining analyst at SP Angel, Stuart Osmeyer, who is director at Concentrate Capital Partners. Stuart is just by the door there, coming on in. And also we have Ian Pearce, who is a non-executive director at Utatec. So thank you very much. If you'd like to come and join us on the stage. Can I have a quick round of applause for our panellists? Okay, I think we'll start this one off with, if you'd like to give us your thoughts on, what are the key drivers, key factors creating excitement in the base metals space and creating opportunities for investment.
Thank you, Leo.
Yeah, it's good.
Thank you for turning up. And I know everybody here is obviously clearly very excited in the commodity space. So I don't want to tell you a lot about what you already know. And I've got some guys here who are obviously hugely expert, and I don't want to steal their thunder. But the way I see it is there are four legs to the market. There's supply, there's demand, and demand is what generally leads pricing. And then there's China and the United States, and clearly they're related to the demand side of things. It's very interesting. I went to a conference given by an economics group, Capital Economics, and they're a bunch of economists, and they look at the global economy and how that's working, and they were quite enthusiastic, and they were brave enough to talk about commodities to an audience of commodity traders and mining guys like myself. And they were focused on the demand side, which is critical, and saying that, look, we're seeing coordinated global growth now. The US, China, and the rest of the world all seems to be growing. I know there are some small negatives places, but they're really not relevant at the moment. And so they were pretty positive in general about the market, which was good, so they didn't get things thrown at them. And what they were highlighting really was, whilst China is not growing as fast, and they're very consistent in this message, China isn't growing as fast as the Chinese say. And of course, if you know any economist very well, you will know that economists are always slightly negative creatures. The glass is always half full, and they never want to buy you a pint, which is always a shame, because they think the world's going to get worse. So for these guys to say the world's getting better is quite good. But they don't know an awful lot about the supply picture, which is key, because what happens is demand will increase, and people will be buying lots of stuff. But the price only really goes up when there's a bit of a supply shock, generally. And this is where we come in. This is where our understanding of the granularity of commodity producers is important. China, of course, has been a massive driver for demand, and still is, even though Capital Economics would reckon that it might not be growing quite as fast as everybody thinks. But of course the United States, which we've all forgotten about for years and years and years, because it's all been a bit quiet in the USA, is actually growing. Now, is it Donald Trump, or was it really the policies of Obama before him? But the United States is growing really well. There's a lot of construction going on over there, and I think there's going to be a lot more. A lot of it's driven by the success of their new economy companies, but it's like they've all woken up. There's new finance back in the system. Construction companies are going as fast as they can. And these guys are buying commodities. So to use a non-base metal example, the Americans put a lot more vanadium into their steel than anyone else in the world. In fact, their numbers are twice what the Chinese put into their steel, and a bit more than the EU as well. So they are big consumers of not just base metals, but everything else. And if you'd used the expression about Texas, everything's bigger and better in Texas. And that sort of applies to the US in general. So there's a lot of demand that I think people haven't really factored into their models coming into the US, and that is really helping to drive markets better. Now, whilst we talk about this, let's not forget what's going on the production side of things. Producers are struggling. The super cycle kind of exhausted the easy growth within the big mines in the world, and that's something we should think about. And one of the examples is copper grades. We now see copper mines mining 0.3% copper. You wouldn't have thought about that 10, 15 years ago. So it's a changing environment. And let's not forget about finance. The lending banks are not what they were. After the global financial crisis, the regulators decided they were going to chop the banks up. For example, Barclays has cut out a lot of its commodity stuff, and this applied to a whole bunch of banks. So the money that was in commodities on the banking side just isn't there at the moment. It's created a market opportunity for traders, and I'm sure we'll be talking more about that, to bring in new money. And I think, the finance side is worth watching, but I think this is really over to the balance between the producers and consumers, and there are significant deficits forming in a lot of the metals right now.
Which metals in particular do you see the biggest deficits?
Well, we're not seeing huge deficit growth from the electric vehicle side yet, but that will come. So I think we've got a deficit in nickel, we've got a deficit in copper, and zinc at the moment, which probably start to balance out. If electric vehicle growth is very strong, as I think we're all expecting it to get there, those deficits are going to balloon, and where is the metal going to come from? And interesting deficits in some of the types of materials being produced. So if you look at cobalt and you look at nickel, the electrification of certain products is going to create big deficits in certain types of nickel chemicals. So that's something else to consider.
And capital economics, you said that China was growing slower than people think. But what percentage growth were they talking about?
Well, they always say this. They're always talking 5.5%. But you know what? We all know what the metals demand is according to the growth as we see it. So they're not saying that that's going to change. They're just saying that the actual number is calculated differently from how we would in the West. So they see that as 1 or 2% lower than the official statistics.
But still, 5.5% in China is a lot of
It's
growth.
still great numbers. And it's worth mentioning that the Chinese are closing so much industry, so much of their old companies for pollution issues. And this is really creating some interesting imbalances. We're seeing it more in the specialty metals, in antimony, in vanadium, and those sorts of things, where whole supply streams are being cut out. So titanomagnetite, for example, is not really a popular material to smelt anymore in China. And the vanadium that would come off some of those product streams, just not there. And hence that's why vanadium prices have trebled over the last 18 months.
But as prices increase, I know obviously China is doing these, closing smelting capacity for anti-pollution reasons, but as the prices rise, isn't the temptation going to be for them to say, well, let's take a bit more pollution and we'll...
Well, there will be a bit of that. I mean, their big focus is steel, and so they cut out a whole bunch of very polluting steel furnaces. But at the same time, they still managed to increase steel production from new capacity coming in and being better utilised. So steel production continued to rise. That's actually quite good for galvanizing, for zinc and things like that. But in other specialty metals, they haven't had the same capacity to bring back in. So that's what's creating interesting price moves in these other materials.
Fantastic. Stuart, let's move on to you for a moment. Can you tell us a little bit about Concentrate Capital Partners, what you do, and then also your feelings on the base metals space at the moment?
Yeah, thank you. I think just very briefly, we were set up as a PE investor, as a technical investor into projects, both early stage and later stage, so funding everything from a feasibility all the way through into execution. Globally focused, pretty much commodity agnostic, as long as we, through our technical partnerships, can add value. So that's really our focus, and we look at risk in 6 areas, and I'll touch on how that links into what John said. So we invest everything from having a look at the geological risks. So we have a geological investment and geological partner looks at projects globally, mine design development consultants, EPC contractors, O&M operators, all the way through to financial partners and off-take partners as well, as to how we can manage risk in an investment through our partnerships that we know, rather than taking a pure equity check and relying on what the market and the analysts will tell you. So when we look at projects, and John touched on it, is, I think it's very easy to sort of understand the demand currently, where it's heading. I mean, we get smart people like these guys, but even they get it wrong from time to time. So we're really looking at the supply and the sort of global market. So, you touched on something like zinc earlier. Through our partnerships, we're actually starting to see a lot of these sort of projects sort of get reawakened, particularly in the zinc market as an example. We're getting reawakened and people are saying, well, now at current prices this becomes very attractive. But as your supply side starts increasing and your pricing starts shrinking, we're sort of looking sort of 5 years in advance. So if we're going to progress something through a feasibility all the way into the build, we're looking at what the price is going to be then by the time you bring it online. So in that regard, we need to understand what's out there globally and how your price is going to look at. So an example is one of our EPC partners is bringing on, has been doing a lot of work at Roshpina and Gamsberg. So, you know, when someone brings the zinc project to us, we need to understand how does it fit in with that we know is going to get developed. And what is it likely to look. So we tend to take a little bit of a more cautious approach because we can see things right at day zero almost in terms of a lot of projects, and we can sort of foresee not foresee, but try to apply our minds as to how we think things are going to end at the end of the day. Because as you know, you don't build a project in a year or two. It takes a fair amount of time frame.
Given that the supply side, though, seems to be driven so much by policy decisions, either by the Chinese government or by companies such as Glencore, for example, in the zinc, they can, you know, turn it on, turn it off. Yeah. When you're making an investment decision, which involves a long investment period, how can you take the risk of, you know, maybe the government in China will change their mind, maybe Glencore will change their mind?
I think naturally, if in the absence of information or policy uncertainty, you're really taking a cautious approach. You can't adopt a more aggressive approach if something you don't know. I mean, Warren Buffett's famous for saying you invest in things you know, and if you don't know it, you shouldn't be investing in it. So we do naturally take a bit of a more cautious approach, but you know, through discussions and relationships, you're able to delve into what these people are thinking and what their development plans are. So, you know, if you chat to a Glencore and you say, so what are your plans for zinc? And you know, we can chat to guys like that fairly regularly through ourselves and our partners. You get a bit of a more clearer, although it's still fairly cloudy at the end of the day, because I don't think anyone that says they know what's going to happen in China is fooling themselves. I don't think the Chinese politicians know what they're going to do in 5 years' time. So you're able to form a bit of a clearer picture, but it's never really going to be completely clear. So naturally you're going to take a bit of a more cautious approach.
And I guess you're going to be looking for projects that will be sustainable even in a sort of lower price environment.
So we're particularly in this space where prices have been running for fair bits. I mean, we almost look at it, you know, as a gut rule, 20 to 30% lower. Is the project still sustainable? So can it sustain itself through the down cycle and at least break even so you can continue running the project? You then have to have obviously patient capital that you can hold all the way back through. So you know, we don't have any of those that have got into execution in the space yet, but you know, it would have been a nice investment to have made 5 years ago.
Absolutely. Ian, if you can bring you in here, from an Oceanic point of view, how's your sort of deal or your project pipeline looking at the moment in the base metal space, and you know, which projects are you seeing getting funded, getting put into construction? You want to take us through that?
Sure. We kind of at the tail end of the process where, you know, as you know, we've gone through this cycle where there's been a downturn. A lot of the operating companies had to fix their balance sheets, get their businesses in order through that last downturn. And so we came through that, and we have seen a change in the market and how the market has responded. So if you look at our business, we supply to the full sort of value chain from upstream all the way to downstream. And what we've seen is a resurgence, certainly it came through in 16 and came through stronger in 17, in customers actually deploying capital to improve the operating assets. So brownfield type investments, debottlenecking, improving the cash position, that sort of capital spend we've seen, and typically in the upstream side of the business, not so much in the downstream, which is the smelter side and the refinery side. But what we have seen is that change as well now. So through the back end of this year, we've seen a stronger order book where we are seeing now some of that spend that's going into the downstream side. And what we're now looking for is the big capital spend. So we've got those different pieces of our business where we're looking for upstream, downstream, and then that's really been around the renewal and replacement capital that you see in the base businesses. And now we need those projects to come through, which is going to be that greenfields type work. And we are seeing some greenfield work coming through. But that base spend is what's been encouraging for us, that says there's a resurgence of spending in the sector.
Are you seeing any particular metals you know, leading the charge on this?
Certainly, I think it's following the trend that you see out there. You know, copper leading the pack, a strong base metal commodity. Zinc, of course, a great business, but we're seeing in metals like aluminium, we're seeing in metals like nickel. So we're seeing across the spectrum actually, and then some of the exotics where you're getting some spend in the lithiums and some spending around cobalt even, where the copper mines are starting to relook at cobalt as being a value driver in their businesses, where before it wasn't a big contributor to the bottom line, where now cobalt, with the price where it is, customers are starting to focus and say, can we actually improve our cobalt recoveries and our cobalt position, because it hadn't been forgotten with the way copper had driven the market.
Absolutely. And where is this smelter capacity being brought on?
So we are seeing a lot in sort of the sort of Western world. So you'll see in the Middle East, in Asia, Russia, you're seeing ongoing spend in that area, but not as much as, say, in the North Americas or South Americas, of course.
If I can just add to the earlier comments, I think sort of over the last 18 months, we've seen, the few years before that, it was really an OPEX-driven model, as companies sort of clamped down, battened down the hatches and were sweating their OPEX budgets. We've certainly seen that turn going through sort of the last 18 months, and we're getting a lot more requests for sort of your generic CapEx spending. So we've definitely seen the market, but what's very key is what we find is you need to be able to look at both markets. There's a lot of optimization still left out there. So I think that cycle will continue for a while sort of companies still need to do a lot of optimizations and increase recoveries and yields on their products. But yeah, everyone's sort of focused on the capex growth and increasing production capacity when you should be looking at both. There's still a lot of room for both. So I think it's fairly good for the sector and the mining industry in general. But obviously, projects don't get built in a day. So we've still got a couple of years to run to bring a lot of these online.
Yeah. And is the bank financing catching up now in this space?
I think the bank financing is fortunate in that it's got a pool of capital it needs to deploy typically into mining. It's particularly if we're talking in South Africa, the banks have been badly burnt by platinum and the like, so they're very cautious and naturally cautious and overweight on that. So they will focus and have room for these things. And in a lot of our discussions, we find the banks are fairly open to discussions on even greenfields and some brownfields expansions in the space, particularly because they see it's something that prices are high, but they also adopt an element of caution in their approach as well. So banks, I can say this because I'm an ex-banker, so banks are never traditionally easy to work with. But I think it's where they don't bear baggage and legacy from some of their past investments, it's just naturally easier. So I'm finding a lot of traction in this space with the banks.
On the financing side, I think you're also seeing some innovative financing. So you'll get, what came through the last down cycle was, of course, the streaming method of financing by setting off streams. But we're also seeing traders actually taking a position where they're looking to secure concentrate, which is a positive sign for the market again, where they're looking to secure those concentrates and actually will lend capital up front to get those projects into production.
So we were actually born out of that in a sense of one of our EPC partners, where the market's really moved over the last few years from EPCM to EPC, and now it's sort of moving to something called EPCF, where they're asking them to put risk capital into projects and take a position and sort of achieve alignment on a project, which is where we try to step in. And we're seeing a sort of a big request for that because you're trying to pull different pieces of capital all together to fit into a project.
But it's really lucky for these guys that traders have got access to capital, because the banks are not really doing it. I mean, if you look at some of the specialized markets like lithium, sure, there can be a surplus of production in lithium, but not even half of those projects are going to get financed because the banks are just like terrified of it. And dare I say it, I suspect that's going to apply to a lot of the cobalt stuff as well. The market's not so mature. You can't hedge it so easily. I don't think you can hedge lithium at all. And if you go back to the super cycle, a lot of growth going up 2006, 2007 was really, well, let's add some more 777 trucks. Let's just move more dirt. We'll push it through the plant. Now everybody's having to get cleverer about this. They can't add more trucks into the pit. The pit can't get any bigger. They've got to optimize all this stuff. They've got to add technology.
At the end of the day, off-take's key for us. So we invested into a fluorspar project towards the end of last year, and the banks on day dot, even before day dot, were demanding they have secured off-take in place before the banks would even start talking to them for non-index products. as an example. So that's why I'm saying banks are willing to enter those discussions, but they're typically very cautious naturally. But something like offtake is becoming more and more key for them for a way of managing risk. Before they even spend time and effort in those discussions.
John just raised the issue of lithium there, and there is this sort of fear of oversupply in the lithium market. What's your take on that? I mean, you mentioned that the banks aren't funding these things. People say that SQM, something could just bring on massive new capacity. What are your thoughts?
Well, I'm sure SQM will bring a lot of new capacity into the market, but the question is, will it be enough? And if there's a whole bunch of projects that don't get financed by the banks, and I'm talking about a lot of those projects in Argentina where evaporation ponds won't really work very well. Depends on they're all talking about using new technology. That's not really proven yet. Nobody has expanded anything big, so maybe it will come in, maybe it won't. But guess what? They're still expanding hard rock mines in Australia, which is doing well. So the financing is going into the better known stuff. But can you imagine if the traders don't have the finance to do what they're doing now, and the banks aren't stepping in, who's going to supply the money to this market?
Yeah, and we've seen. So we've looked at 2 lithium investments. I agree. Spodumene is far easier than rock deposits. I think unless you've got deep technical experience, you're really fooling yourself if you think you can play in that market. So we've seen that in a bunch of offtakes. So I agree with John. I think there's going to be some painful deaths in that market. We're fortunate enough where we can play in the earlier stage space as well. So we're able to get into a lithium deposit and exit 2 weeks while market's running at 6 times the money. And that's sort of stuff that makes people excited at night. But it doesn't mean a project's necessarily going to get built. So I think echoing to say there will be some painful deaths in the sector. And I don't think banks are really there yet in terms of their critical point. There's some that are getting built right now, and those ones will go ahead with secured offtake. I think some guys are a fair bit behind the game, and we'll wait and see.
Is there any risk from recycling in the lithium space? There are people working on recycling lithium batteries, getting that lithium back into the market.
There is a risk. I'll tell you, the risk is that somebody picks up a load of lithium batteries, as they did a while ago in the States, usually with some sort of mechanical grab. They drop them into a truck, that truck then going through a built-up area, and it explodes. And when it explodes, it rips the container apart. It's a dramatic thing to happen. And there was this big explosion about a year ago in the US, so everyone's going to have to get more careful about how they handle old batteries. Sure, they can be recycled, but there are inefficiencies in that, and it's going to take a few years for that really to get going. So I don't see a massive risk from supply on the recycling side for a while yet.
And on the demand side as well, you often hear people say, oh, well, they're going to invent a new battery which doesn't contain lithium, but that seems to be a fantasy, doesn't it?
Well, that's just going to drive more demand, frankly, because as soon as anyone says, I've got a better battery, it'll give you twice as much power, or maybe give you the power twice as quickly, or it recharges in half the time, you're going to want to swap your old batteries for that one really fast. And it'll take a while for the recycling chain to catch up, because everything takes time.
Yeah, absolutely.
Yeah, I think if you look at the metal markets, I mean, battery demand is good for all metals. And there will be a race and substitution going on based on where prices go to, and that's happened through our industry for the last several decades and will continue. So, but it generally will mean that that's a good thing. So we've got the driver of sort of the ongoing industrialization and urbanization of China that's driving the base commodities, and then you've got this electrification that's coming in with the battery technology and automobiles and that hype as well. And I think those two are very, very positive for the metals. And if a metal price gets out of whack, then the normal fundamentals come back and say supply, demand, substitution will come in, and somebody will invent a battery that'll help you through that dilemma. But overall, I still think it's going to be fundamentally good for the commodity space.
And I think also some of these new, people mention solid state batteries, but they actually contain more lithium than current lithium-ion batteries, as far as I'm aware. But anyway, vanadium, is another potential battery material to look at. What is the development of redox flow batteries? How's that coming along? And
well, there are people in this conference are better at answering this than me, but vanadium prices have tripled in 18 months. That's really on the back of steel. Not even the battery demand hasn't even touched that in reality. But the batteries are now being tested. The Chinese are building a very big one. And you know, if they're successful with that, I think they'll roll that out really fast. The scale that they're building at is sufficient to suggest that they've got quite a lot of confidence. I know you've got Bushveld Minerals, who are part of a program here to build a number of vanadium redox batteries as well, and the guys in the States doing it, and there's a company called Red Tea working with them in the UK. So it's coming. The question is, you know, will people buy big battery packs for for grid storage from Tesla going forwards, or will they buy vanadium redox? And I think Tesla will get more and more busy with cars. I think the reason why Tesla are supplying big battery packs now is because they've got a little bit of excess capacity because the car production didn't grow fast enough. But I think they'll get busy with that, and the vanadium redox batteries will probably come in because they do work. It's just a question of everybody getting used to making them work.
But yeah, the one thing you have to bear in mind is you're going to work through those batteries, and then you're going to have to work your way into the ultimate endpoint, which is your vehicle market. So the likes of a VW and a BMW are already setting up their structures all to take lithium batteries. So if you're going to start changing things around, you've actually got to go through that cycle as well with all of them. And I mean, they're planning on sourcing their products locally. Sounds better, looks better to the market, and things like that. So now, if you sort of start changing tack, it's a very difficult road they're going down, and it's going to be tricky. It's certainly not going to happen overnight.
The one metal we didn't discuss, and I'll throw a curveball in here, is nickel. And so, I'm old enough to remember the days of Falconbridge and Inco. And their thesis back then was the nickel sulfides were running out and the nickel laterites were going to be the future of nickel supply. And then came along nickel pig iron, and the whole stainless steel drive, and nickel pig iron has become a floor ceiling to the price of nickel. But what's interesting is that is a nickel iron compound that doesn't go well into pure primary metal. So when you look at the market is very much, and the price of the market is very much driven by the stainless steel demand, which is consuming more than 60% of the nickel in stainless steel. But that other 30% of alloys and specialty metals that need pure nickel, when you look at the security of supply coming out of that, where's that going to come from? And if you add in electric vehicles and you start adding nickel demand from there, it's going to put pressure on that 30% of the market. And that 30%, if you go back to the old theory then, it can't come out of the sulfide space because there's a depleted resource there. It's got to come out of the laterites. If it's got to come out of the laterites, where are those projects and where's that supply going to come from? And so that's going to be an interesting dynamic in nickel, where I think it may start to drive a low nickel price set by stainless steel, but then a premium for primary metal driven by the demand for that specialty high purity nickel. And
as well as the primary metal, you've also got the nickel sulfate high purity, which I think attracts an even higher premium and lower cost of production.
Right, which can be used directly into batteries and things like that.
Absolutely. So are we going to see nickel miners everywhere adding production capacity to be able to produce nickel sulfate, and then a potential risk of oversupply?
Well, I think it goes back to I think the general thinking around when you look at let's go get a project going, when you look at the timeline it takes to get a project into production, it's getting more and more complicated with a multitude of issues that are going on behind these projects. So when you say, okay, let's go get some more nickel sulfite, where's it going to come from? And then you say, let's go build that project. Well, you're talking 10, 15 years before that project's going to come to fruition. I'm talking about these bigger projects now. So,
and particularly with the lower grades, you've got to have it as something of scale. So you're really talking a long time frame, yeah, which is something I don't typically like, and sort of investors don't typically like investing in. You want to sort of get your cash after a few years.
Sure. There's a guy speaking at our Hong Kong conference in April, actually, who's going to be talking about nickel, and nickel sulfate in particular. He's working with a company down in Australia, in Western Australia, and they're putting in a plant to produce nickel sulfate, and it attracts amazing high premiums and very low costs. But anyway.
Well, I've got to say, we're floating a couple of nickel companies this year. Brazil Nickel quite soon. It's not going to be big enough to change the nickel market, sadly, but it's an example. And then there's another one, Consolidated Nickel, to work with the old Munali mine in Zambia. So there are people bringing these things through, but they're not huge projects. If nickel supply is going to keep up with the demand for nickel in batteries, there's going to need to be some big projects coming in.
Absolutely. Do we have any questions? We have a question down here.
How do you see
bauxite? Say that.
Sure. So one of our partners is currently building a large bauxite project in Guinea, and things are quite positive in that space. But what is very key for them was sort of how they were going to handle the offtake. And they spoke to a variety of partners, and they got the offtake in the end. So what immediately followed was a flood of, well, you know, these guys have built, and would you mind looking at funding all of these? Naturally, you reach out to your offtake partners, and I chatted to a very large sort of player in the space. And their view was they were looking at sort of four around West Africa, picking you know, one of the different bauxite players. So very similar to the lithium space. Very worried about who's going to actually get traction, because you're pretty much going to take your offtake for bauxite all in one go, or maybe potentially two partners, but. You know, so I think very cautious in terms of which ones are going to succeed and which ones are not. But, you know, at the end of the day, these actual projects, the viability of the projects is all driven by the logistics. So what we're seeing is guys getting very innovative in terms of transshipping and getting their product ready to get to the offtake. So again, it's one of those things we'll have to wait and see. A couple of them are going to succeed, and Guinea's been in sort of the immediate drive of that. Other countries like Cameroon, we'll have to wait and see if any of those manage to secure the offtake and eventually progress. The other thing I'd point out is a lot of these projects were typically, you know, very much underdeveloped. They were dropped by the majors, the likes of the BHPs that had left large projects. Now those FSs all have to be dusted off and rejigged over another 12 to 18 months. So we're seeing a lot of those go through now, but it's typically with a lot of guys that have picked it up that don't have a lot of money. So they tend to come to us, and you know, you can't develop these things overnight, and particularly when you don't have money. So yeah, a bit nervous when I start looking at bauxite projects. Offtake's again key for me.
Unfortunately, we have run out of time there. That was a fascinating discussion, and we could continue talking about this for a lot longer, I think. I think we've painted a very rosy picture there of the base metals market. My next question would have been, do you see any downside risk? But we'll leave that for another day and just keep this nice rosy picture. But can we have a big round of applause for our panelists? Thank you.